Okay, it is 12:02. Let's give it like another minute or so because I think Sonia has it to where she can pretty much um do it in that time frame. And we have some people in the waiting room. So let's give it like another minute or so. All right, it is 12:03 and we like to get started because we understand people only have so much time. So we want to welcome us to your Power Hour for January 2024. And we are going to have a very great speaker today, Miss Sonia Benson. But before we get started, I want to give our president, Rhea Cotton, some time for to say a couple of words.
Thank you, Parisha, and good afternoon, everyone. Welcome to another Power Hour. I am so excited about today's session because we know that we all have clients that need it. And I just want to make sure you look out if you haven't received our emails, look out for our emails, check our social media. We have all of our awesome events and information on our social media outlets. And you will also be seeing soon, very shortly, our first edition of the CAREB magazine coming out this weekend. Thank you.
All right, thank you. Thank you, Madam Rhea. And is there any other announcements that anyone else wants to make before we get started? Or would you like to make some announcements afterwards? Because before I announced the prospecting, but by that time everybody had left. Did you want to announce that real quick, and then we'll follow up with one later on as well, the other prospecting we have for our members?
Absolutely. So on February 6th, we have Prospecting Tuesdays. Prospecting Tuesdays is every first Tuesday of the month where we get online and support each other. We do a little role play, start off with a little role play around 7:30 a.m. And then we get on the phones from 8 a.m. to 12 noon prospecting for new business. And it's an awesome experience. We have great testimonials from our members that have already been on the call. And it's a very supportive environment to help build your business. So look out for February 6th. You, again, on the magazine and our social media and e-blast, you'll see registration for our Prospecting Tuesdays and some more legislative updates as well.
Okay, thank you. Thank you, Madam President. I want to make sure we had that covered because I missed it last time. So, as you know, in Power Hour, we're trying to bring very much value to our members. And so today we have Sonia Benson, who's from Cure My Credit. And she's going to be explaining some things about credit, maybe going into some business credit, some overviews, but be an open book and a sponge. And Sonia, take it over.
Thank
Oh, give us a little bit of
you.
your bio because I don't do the bio. I apologize. So give us a little bit of your bio.
Not a problem. Not a problem. I can introduce myself. Thank you so much, Parisha, for inviting me, and Maria for having me. So I appreciate the opportunity to present about credit, and it's actually a topic that I can talk to people about all day long. So it's something that most of my friends say I won't shut up about. But they like it. I'm Sonia Benson. I am a senior credit analyst with Cure My Credit Scores, and I am a coach. So I actually work with clients. We work with clients all over the country to support them in getting their credit scores up, and we have been in existence for over 8 years. So one of the things that I love that we do about one of the things that I love about Cure My Credit Scores is that we work primarily with realtors and lenders across the country. We actually have thousands of realtors and lenders that we are part of their nurturing team to support them in nurturing their clients until they are ready to purchase a home. And because of that, we actually speak your language. So when you pass them off to us, you can know that we're talking about things as it relates to purchasing a home. When I'm looking at the credit report, I'm looking at it through the lens of their goals and what they're trying to do, and then supporting them with, I like to let them know we're all on the same, that we're working to be all all be on the same page. So I'm looking out for your best interest, because even though, you know, you refer a client, I like to tell my clients all the time, actually, your realtor, your lender is my client. You're just, you know, you're my client too, but your realtor lender is my client. So I am going to go over credit and how it works. One of the things that I love, 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 love about what we do is we don't just support clients in getting their scores up, we educate them about how credit works, because we like to say credit is this game that we're all playing, but we don't know the rules. And as a result of not knowing the rules, we often don't play the game well. So we like to demystify credit and explain to clients sometimes some of the things that you may not know that are hurting your scores and you're just not aware of it. And then also, you know, besides some of the obvious things, and also some of the things that you could be doing that you're not aware that, you know, would actually help your scores. So I'm going to go over that information today and go over some of the things that we will be supporting your client with. But, you know, just so that you know as well, because a lot of times I find that most of my realtors and lenders, and actually, believe it or not, my lenders don't know some of the things that we teach about how credit works. So I know you guys know the scores, not always what goes into creating them. So I'm going to share that information. I'm going to share my screen and we're going to go over that. And then once I would love to hear your questions about either, you know, credit, how the program works. And then I'm going to touch a little bit on business credit, because that's the other thing we support small businesses in doing, including realtors and lenders, in establishing business credit so that you can get access to funding, especially for those down times when you're going to need it. So I'm going to share my screen. Let's see. Do you see my screen that says understanding your credit? Okay, thank you. Thanks, Maurice, is it Marisa? Yep. Marisa, okay, Marisa, okay, thank you. All right, so as everybody knows, your credit score is a 3-digit number, and it usually has a range from about 300 to 850, depending on the actual scoring model. However, what a lot of people do not know is that there's no such thing as your set credit score. It varies depending on the formula that's being used to pull it. And so that's why a lot of times clients can, one of your clients can tell you, oh yeah, I have a 720, because they were looking at Credit Karma and Credit Karma told them they have a 720 and they're going to stand on that all day. So they're like, I have a 720. And then you send them to the mortgage lender, the lender pulls their scores and the mortgage lender says, we see a 619. It is not that the lender just dropped their scores because they pulled them. So sometimes that's what the belief, like, okay, pulling my scores just dropped my scores 100 points. Or a lot of my clients believe Credit Karma is the devil and that they're pulling wrong information. That is also not the case. It's that there are hundreds of formulas and a lot of people are unaware of that. So you can go to 10 different banks today or 10 different lenders and have them give you 10 different sets of scores, because depending on the industry, scores can be graded. What's on your credit report can be graded differently. So I like to explain to clients, Credit Karma is using what's known as a consumer score, and it's on a Vantage Point Vantage Point platform. So those scores tend to be a little more generous, and a lot of times they look a lot higher. The mortgage lender is being a little tougher because they're looking at the likelihood that you're going to default on a mortgage loan, whereas the consumer score is looking at general consumer products. So a mortgage lender is generally being a little harsher when they're pulling your scores. And so those scores can be a lot lower, and sometimes they can be as much as 100 points lower. So we will see clients be, you know, very confused by the difference. Also, there are automobile scores. And so automobile scores grade you using looking at the likelihood that you're going to default on an automobile. So what I often tell clients is when you get your scores pulled, find out who's pulling those scores and what formula they're using, so that you're not comparing apples and oranges. Otherwise, it can cause you some confusion because you think your scores just went up, and then you think they just went down, and then you think they just went up. And it's like, no, you're not even looking at the same actual scoring model. Now, the other thing that we discuss with clients when we pull their scores, we use the most common formula that's used to approve loans, and that's a FICO 8. Now, that's not what mortgage lenders use. FICO 8 is typically, most mortgage lenders use a FICO 2, a FICO 4, a FICO 5, somewhere in that ballpark. However, what we do with your clients is get their scores about 10 or 20 points higher than what a lender is looking for, and then have the lender pull and have the lender tell us, okay, so yeah, this is what we see. And it looks like the client is going to need a few more points, or looks like we're right where we need to be. So that's kind of how we mitigate that. In addition, there are 5 factors that impact client scores. So we like to break down those factors so that they understand what's causing your score to be what it is, and what can you do about those things. So I'm going to share my screen. I'm going to change to another screen and show you the 5 factors. Do you see that big pie chart? Okay, great. All right. So these are the 5 factors of your credit score. These are what we go over with our clients so that they really understand what is going into your score. And we also recommend best practices for each one. Now, as a coach, what I am doing is I am looking at analyzing each client's credit report through the lens of these 5 factors, because I'm looking for room for improvement. I'm trying to see where they're likely losing points and where they could stand to gain more points. The biggest factor is your payment history. It's 35% of the score, and it has to do with how bills have been paid. So I tell clients, if you have late payments, collections, foreclosures, bankruptcies, charge-offs, anything negative on your credit report, it affects that particular area. This area is so impactful. We gotten a client to a 720, they paid one thing late, their scores dropped down to the high 500s. One new late payment can wipe out your scores, and I recommend to clients to avoid them at all costs because it can really be like hitting the reset button and undo any effort that they've made with trying to get their scores up. And late payments require time to get over. So it's not something that as soon as you bring the account current, boom, you get your scores back. Doesn't work that way. So often we recommend to clients, one, that they put as much as possible on auto pay. We've seen clients have a late payment, not because they didn't have the money, but because they forgot, because we're juggling so many things. And when we say late payment, we're not just saying something that's 5 or 10 days late. We're talking about an account where the client has skipped an entire payment. So where where October was due and now it's November and you still have October due. So now the creditor is reporting that you are 30 days late. One new late payment can cost as much as 180 points. And the higher your credit scores are, the more a new late payment is going to cost you. So somebody who's in the 700s and 800s, they pay more for a late payment than somebody who's in the 5s and 6s. I know, it's really harsh. Actually, I had a couple that was in our program that we were getting their scores up and they were building a house. So they were watching their home being built and we were working on their scores, got their scores to where they needed them to be. House now ready to move to closing. The husband forgot a $5 payment. It dropped his scores 100 points and they were unable to buy the house that they had just bought. I know, it was devastating. And I use that as a story of caution to all of my clients because I'm like, you do not want a $5 payment to wipe out your scores. And there's sometimes an impression from my clients, well, it's $5, so it can't possibly hurt my scores that much because it's not a big payment, but I like to explain, it has nothing to do with how big the payment is. It has to do with them looking at the behavior. And so often, part of what we're doing while we are educating and coaching your clients around what gets to happen to get their scores up, we are also holding them accountable. And sometimes I'm having a sit down because I'm explaining that you're not just getting your scores up, you also are adopting a behavior of someone who owns a house. So, that might mean changing some of your behaviors in terms of how you viewed and handled your finances in the past and where you get to be now. So we recommend that clients put everything as much as possible on auto pay. We also dispute everything that's negative to try to get as much of it removed as possible. Anybody have any questions about the payment history section? And I'll take more questions at the end too. All right. Next part of the pie chart is how much you owe or your debt ratio. This has to do with credit cards. So what a lot of people are unaware of is that you cannot have great credit if you do not have credit cards. Credit cards are actually worth 30% of the score. So we've seen so clients, if you do not have a credit card, or if your clients don't have credit cards, they are it's like being in class and having a teacher tell you that your final was 30% and you decide, I'm gonna blow that off. I'm not taking it. The best you could do in that class would be a 70%, which is a C. Same thing with your credit. So if clients are missing credit cards, they're missing a huge chunk, but we know how to get them approved, because it is hard to get approved for a credit card without having good credit. But we know how to support clients in getting that done. So now let's say that a client has a credit card that's $1,000. Most folks are unaware, or some folks are aware of utilization, because that is something that's a little more little better known on the internet, and that's how much you're using of your credit cards and how to calculate your utilization, because that impacts your scores. If on $1,000 credit card, if you were to spend $500, that puts you at what's known as 50% utilization. And but whenever you're above 30%, it hurts your credit. And most people hear 30%, they know 30%. That's kind of industry wide, or industry standard. However, a lot of people are unaware that really 30% is right where you are hurting your scores, but it doesn't help you as much, because you're like right at the edge of being right at the edge of being at the point that you're hurting your scores. What we recommend is that clients be at 10%. And we recommend 10% for two reasons. One, causes the scores to go up quickly. Two, causes the creditors to consider raising your credit limit. So we recommend, so for $1,000 card, we would be saying not to spend more than $100. Initially, clients are in shock. They're like, what do you mean? When I tell them that this credit card that you have a $900 balance on, you're going to need to get this balance down to no more than 100. So typically, there's some resistance around that, but I like to let clients know they're testing you when they give you credit cards. It's like giving you a cookie jar full of cookies, and they want to see what you're going to do. Are you going to ball out of control, eat up all of them, or are you going to have a couple and put the rest to the side? So when you have a couple, it kind of demonstrates a few things. One, that you have some financial discipline, that you know how to manage yourself, and also it gives the impression that you must be doing okay financially, because even though you have access to the money, you don't have the need to borrow it. So that's why we recommend no more than 10%. And actually, studies show that most people who are in the 800s have their balances below 10%. So of course, we want to model that behavior. In addition to being too high on a major credit card, it's possible to be too low. That's called being underutilized. And so most people are unaware of that. It's for major credit cards that are less than 7 years old. Whenever they are below 1%, you lose points as well. So we've seen clients pay credit cards down to zero, thinking you're doing a good thing. Like, okay, yeah, that's a good thing. I'm paying them all off. But actually, it's costing you points. So we recommend a client keep their scores between 1% and 10%, because when you pay down to zero, you could lose anywhere from 20 to 50 points. So you lose points as well that way. So for that credit card that's $1,000, I would be recommending to my client, keep that balance between $10 and $100, and do that throughout the month. Because the other misconception, sometimes people believe that, oh yeah, all credit card statements are reported on the 15th of each month. It's not true. Or that my creditor reports on the same day each month. That is not true either. That is a moving target. And so I like to let clients know, if they go outside of the range that we recommend, they could have a balance reported that they don't want reported, and that's going to result in scores that they may not want. And then you have to wait an entire month before they report again, and once your balance has been corrected. So we do, usually when I'm working with a client, I'm looking at the credit report. If they don't have it, as I mentioned, if they don't have existing credit cards, I'm supporting them in opening them. And if they do have them, I am telling them the balances that we recommend for each card, and we're giving them a strategy on how to pay those cards down to get to their scores faster, because there is a method to the madness that would have your scores go up faster depending on how you pay the cards. Does anybody have any questions about credit cards, or what I've said so far about the credit card utilization? No.
Question.
Okay. Yes, Parisha.
Okay, so the credit card utilization, if you're saying moving forward and it takes 30 days, so every 30 days you almost have to maintain it constantly every 30 days at that 10% to maintain that credit score? Is that what we're saying? Like we can never like run into an emergency, run it up because then we run the risk of messing with our credit score?
It depends on around the time of the month. So let's say that let's say that your creditor typically reports somewhere in the ballpark of the 15th. You can't um stand on the fact that you think it's going to be the 15th of every month, but it'll be in that vicinity. So yeah, so if it's the first of the month and I have to run out and pay for this car to be fixed, I would recommend that once that's done, pay it back as soon as possible, just so that they don't report it with that balance high. Um, as the closer you get to the 15th, the more you run the risk that they could report it. Because what if they report on the 10th this month or on the 11th? So you just want to, typically while people are in our program, we're trying to keep them tight. So I'm attempting to support our clients with not getting into the habit of using them as we're approaching purchasing a house, because I want them to, let's get these balances down and just keep the balances in the range that we need them in, so that we are not taking the risk and getting the scores up faster so I can get them back to you so they can go ahead and get pre-approved. So while we're in the program, we're recommending they keep that tight, and also we're recommending they keep it tight whenever they have anything that they're trying to get approved for. Now, if you don't have anything right now that you're like, I need to get approved to buy a da 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 da, then if you do use the card and it reports a balance that you don't want reported and it drops your scores, next month when you get the balance back down, it's going to correct itself. So if you don't have the need to use the credit in the next few months, then you should be fine. So I'm not saying that, especially I tell people, once you get this house, ball out of control, do what you want to do. I don't really need you to keep it that tight, but you just want to be aware of where they need it to be so that you can get back in range when you know that you want to get approved for something else. Does that answer your question, Parisha?
Yes, it does. Thank you.
Okay, you're welcome. Yeah, because even on some of the cards that people don't use, where I'm saying I need you to keep at least 1% on it, I'm having them do that while they're in the program, because I want them to we want to hit this score so we can get pre-approved. However, once they're done with this, it's like they're being extra disciplined as they're getting prepared to buy the house. But I'm like, once you buy this house, then okay, keep it at 0 until you know that you need to be approved again. So yeah, I hope that helps. Anybody else? Any other questions about the credit card? That was a good question, Parisha. All right, so now next part of the pie chart is the length of your credit history, or the average age of your file. This one is actually really important because it's organic. This area looks at all of your open accounts. So it looks at every account that's on your credit report, and it looks at how old each of those accounts are. And it takes an average of the age. So one of the things that we recommend for this area is to never, ever, 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 ever close credit cards. You want them to stay open forever. You want credit cards to get to age gracefully, because the older they get, the more they bring up your average. Whenever you have new accounts, they are babies. They bring down your average. So I have a girlfriend that has an 850. And one of the reasons that she does is she has the credit card she opened when she was 19. And so those credit cards are, and she's now 50. So those credit cards are really, really old, and they bring up her average. Whenever you have an account closed, it is likely going to hurt your scores. And a lot of people are unaware of that. And that includes auto loans. I had a cousin who during the pandemic was like, oh, I'm staying in the house. I'm not spending as much money. I'm going to put all this money on this car so I can get it paid off. And I explained, she said, so my scores can go up. And I said, well, no, actually, they're not going to go up. They're going to go down. Oh, no, that doesn't even make sense. Of course, they're going to go up. So she paid it off, not listening to me. And her scores dropped 30 points. And then she was mad at me. And I'm like, I don't know why you're mad at me, because I told you not to do it. Now, credit card, the installment accounts, we have no choice. At some point, you're going to have to pay the last payment on that account. and that account is going to close. But when it closes, let's say that was a loan that it now grew to 5 years old. That 5 years was helping your age of file, and now that it's closed, it's gone away. In addition, all of that time that you spent paying that account on time is now no longer helping your credit because it's closed. So that's why we try to offset that by having credit cards that are really, really, really old, because they almost anchor your age. And then know that, the installment loans, you will have installment loans that come and go, and they're going to close and they're going to open. But I tell clients too, getting your scores up higher and then closing a car loan, it doesn't hurt as much when you lose points from 700 and 800 scores than when you're at 5 and 6 and you're still working to get your scores up. So now we recommend that to get client scores up in terms of keeping their credit cards open. In addition, sometimes we look at other strategies to support the age of file, one of which is being added as an authorized user, but it's not authorized user tool is not something you want to use willy-nilly. That's where you get added to somebody else's credit card as an authorized user. It can help you adopt the history of that account. So the age of that file helps your credit. However, you have to be very, very critical about what you get added to, because that can also hurt your credit. So we are very strategic about what we would recommend our clients get added to, if anything. So we look at that, and there's a few other strategies that we have to support clients and also aging their file. Any questions about the length of your credit history? No. Okay. All right. And usually this one, I like to let clients know this one's a little more challenging because of the fact that it is organic, because it usually requires time for those things to age. Because often clients will say, "Oh, I closed this credit card, but okay, if I open it back up, will that be okay?" And I'm like, actually, opening is going to start you with today. It's not going to give you that 10 years from when you opened it 10 years ago. It's going to start you with a new account today. So as much as possible, you want to hold on to the old age of those old files. Even if it's an account that you really don't like using anymore, it's worth keeping it open. All right. Next part of the pie chart, new credit accounts. They occur whenever you apply for credit. It causes a hard inquiry that stays on your report for 2 years. But really, it's the accounts, it's the ones that happen in the last 6 months that hurt your scores. So what we recommend to clients is to have no more than one inquiry in a 6-month period, and you should be fine with that. Now, of course, that's different as it relates to purchasing a home, because there is a shop around period that's given to you for clients to be able to shop around for a better deal. Those usually collapse into one inquiry when in the algorithm. And sometimes it applies to automobiles, not always across the board. But in general, when clients are opening accounts, we just recommend that they keep it to one in a 6-month period to minimize the impact of this particular area. Anybody have any questions about inquiries? No. Okay. And then the last part of the pie chart is the types of credit that you have, or your mix of credit. Typically, they're looking to see that you have diversity on your credit report and that you can handle different types of credit. So what we recommend to our clients is to have a minimum of 2 major credit cards, 1 department store card, and 1 installment account. But we do explain that even though that's recommended as a minimum, that doesn't mean we'll rush right out and open accounts wherever there are gaps, because each new account, 1, is going to cost you an inquiry. 2, is going to lower the average age of your file because it's a brand new account. And it could possibly lower your score. So we're strategic about what we're recommending be open, with the intention that whatever we're recommending is going to cause an increase in scores. In addition, of course, we are emphasizing the fact that you're not opening anything besides what we're recommending, because your lender is typically not going to want to see new accounts on your credit report. So we are usually trying to reiterate the things that we know that that they would be being warned about, especially like furniture and that sort of stuff. So so yeah. So anybody have any questions about the 5 factors? No. Okay. So now these factors, I like to tell clients these are tools. These are the tools that we use while they're in the program to, we do have a question. Ethel.
Yes, hi. So what
Hi.
if the credit card company closes you down because you don't use it? Does that go against Does that go against your credit?
It does.
And is
Thank
there
you.
any consumer rights with that, especially if you're already in good standing?
Got it. That's a good question, Ethel. Thank you for that. So yes, so one of the ways that your credit card can close is because your creditor decides to close it for any number of reasons. One of them can be due to inactivity. And no, um, there's no consumer rights with respect to that where they owe you to have that account. So they are actually choosing to maintain that relationship with you based on, I'm sure this is a um, one that they can terminate that at any point. So what we do recommend though to keep accounts from closing on you because of due to inactivity is to use it. Usually I would say use a credit card at least 2 to 3 times a year, just so that they see that you're using it and that you are, and that they want to keep that account open. What a lot of clients don't know is that credit cards actually, the creditors are paying insurance on your credit limit. So when you're not using the account, they're paying out money, but they're not making any money. So you just want to almost keep them on the hook in a sense. So you want to show, oh, we might make money from her. So you want to buy a couple of things a year. Even if I tell people, go buy a pair of earrings, go buy a belt, and then pay it right back off. You just want to show that you're using the accounts so that they actually choose to keep them open. That's a good question. All right, and I think, was there one other thing that you said? I think I may have missed the second thing that you said.
No, you talked about the consumer protection not being in our favor.
Yeah, it's not. Actually, it's not in our favor. I don't know if you guys remember that Wells Fargo a couple of years ago announced that we're no longer going to be doing lines of credit. So we're closing all of our lines of credit. We know that unfortunately for some of our clients, some of our customers, it's going to hurt your scores. There's nothing you can do about it. We're just not carrying that product anymore. And so that can completely devastate your credit. If all the eggs in somebody's basket was that, if that's all the credit that they've demonstrated on their file and that account closes, they're starting from zero. And that this person could have had an 850, but have that account closed, then it can go away. I also had and I'm going to answer get your question next, Marissa. I had a husband come to me wanting me to look at his credit report because he was unfortunately about to go through a divorce, and he wanted me to take a look at his profile and determine how that might impact him. He was in the 800s. So great scores, great payment history, has the mortgage on his credit, and then also 2 credit cards that he's had open since forever, since Moses was around. So these cards are really, really old, and they were really helping his credit. But they were the two cards with the same creditor. So if that creditor for some reason goes out of business, he is in trouble. Also, once they pay off, because they're divorcing, they're going to need to settle this mortgage. So they're probably going to sell the house and pay off the mortgage. And I think the mortgage was the third oldest account on his credit. So that account, so he's about to lose the age on the mortgage. And in addition, the 2 credit cards are in his name. However, his wife, she's only an authorized user on one of his credit cards. And I'm sure that you guys are going to separate your finances and you're going to remove her as an authorized user. So he said, well, yeah, but I'm going to see if they could give her one of the credit cards. I'm like, that doesn't work that way. You are the primary on both of those cards, and she's going to be removed. So now she's going to be starting over from ground zero because she has no cards that are in her name that are that old. And I did tell him he needed to open an account with another creditor to start building credit with another creditor. Some reason that company goes out of business, or if God forbid somehow his relationship gets tainted with that creditor, he could lose his credit and go back to looking as if he has brand new credit. So there's often so this is why we talk about it being a game. It's like we have to know what the rules are so we can strategize and do what we need to do to get the not only get your scores to where you want them to be, but also keep them where you need them to be. I hope that helped. Marissa, what was your question?
Just real quick. So on that authorized user note, if you're an authorized user on somebody else's card, can you remove yourself as an authorized user, or do they have to remove you as an authorized user?
That's a good question. That varies per creditor. So in general, the idea is that you should be able to call the creditor and say, I want to be removed from this credit card. However, some of them are a little more restrictive and they require that the primary card holder remove you. However, I just had a client like that today because for some reason he's still on all his ex-wife's credit cards and she just ran them all up. So he was on 3 of them and they're all maxed out. So, and he didn't know he was still on them. So I'm like, you've got to get removed. So he called Chase to ask them to remove them. And they said, well, no, you have to talk to her. Well, they aren't speaking. So this is not, and she probably would be like, I'm not removing you. She, depending on their relationship, she may be trying to do him harm. So we had to actually have him contact the credit bureaus to say, I did not authorize for me to be on this card. Please, I need to be removed immediately. And so they told him they would actually take him off. So yeah, so generally, it depends on the creditor, but generally you should be able to remove yourself. That's a good question. All right, any other questions about the wheel? No, so okay, so these are the types that, as you can see, I don't know if you can see the excitement in my face, but when I start talking about credit, I can talk about it all day. Because to me, the other part for me is that I believe for our communities, this is information that we need. Like this is what, in some ways, if we knew some of the things that we need to do to strategize, we could be in better positions. Like me telling parents that in order to help your children start their credit, add them to your credit as an authorized user because some folks, their kids come out the gate with 700. But we don't necessarily know that as something that we could be up to. So, if we know how to play the game, and then also maybe I think that would have us behave very differently, because if I know that this is my oldest credit card, I want to protect it at all costs, then, maybe I may not just, let it go into collections. I might be a little more protective of that, knowing it's going to be harder to come back from. So yeah, so that's something to consider. I want to show you guys really quickly. Let's see, one of the things that we go over with clients is what the cost of bad credit is. And so I show these 2 people that are purchasing this vehicle, showing that person A has scores that are higher than 700. As a result, their interest rate is a lot lower, monthly payments a lot lower. Person B, lower credit scores, interest rate a lot higher, monthly payments a lot higher. But to me, the biggest difference is how much they're actually paying in interest. Person A they're paying a little over $2,700 for this car. Person B is paying over $12,000. Same vehicle, same options, same leather seats, but person B is paying over $12,000 because of their bad credit. So they're paying over $9,000 more for this car. So I like to let clients know that, we're not only in the business of trying to get you to a place that you can get pre-approved and so that you can so that you can actually get approved for the loan, but you want to get your scores as high as possible so you can get the best interest rates possible. It's going to make a big difference in terms of how much house you can qualify for, and then also in terms of how much you're paying each month for the mortgage. So we're really trying to support them in understanding the difference between the two and how much, because I think it's hard to understand how much bad credit is costing us because we often don't see it on paper. Does anybody have any questions about this slide?
Okay, I have a question, and it's kind of
Yes,
tied
ma'am.
into it because I know that you said that the mortgage credit score and the consumer credit score is different. So the auto loan will go more under the consumer credit score, and those would be more the Credit Karma credit scores that might be more in line with that, or am I thinking differently about that?
Actually, no. Automobile, it has its own lane. So automobile has their own scores. So there are automobile scores, there are mortgage scores, and then there are consumer scores.
Oh,
So yeah, the automobile industry has a whole different scoring system because what they look at is like, okay, so have you had an auto before that you paid off? Do you have autos that have been repossessed? Do you have late payments on automobiles? So then that may make your automobile score be higher or lower.
okay. All right.
Yep.
Thank you.
Yes, you're welcome. You're welcome. Let's see. Now I wanted to show you guys a couple of clients. Anybody have any questions about this slide? No, I often tell clients, I'm like, this is the equivalent of you being in a showroom and having a salesperson tell you that they just sold this car to somebody for $25,000, but they're going to charge you $34,000. We will be outraged and asking to see a manager, but we do it to ourselves when we have lower credit scores. So this is where we get to see how $9,000, there is so much more that you can do with $9,000 for you, your family, your kids, generational wealth, investments, all sorts of things besides giving it away in the form of interest in purchasing something. All right, so just something to consider. Let's see. I want to show you a couple of clients we've been able to support with getting their scores up, and then I want to take I'm going to touch on business credit really quickly and then take any more of your questions. But this is Mr. Clark. He came to us wanting to buy a house, and when he came initially, he thought it was going to take a year for him to get his scores up. We got him. Let's see, he came in the middle of June with a 491, a 508, and a 490. We did some work disputing his negative items. He paid his cards down like we recommended and did other homework. 2.5 months later, we got him to a 694, a 678, and a 675. And he was able to move forward and purchase a house a lot sooner than he thought. This is not everybody's time frame. It happens to be his time frame. But it just gives you an idea of what's possible. We actually guarantee to get our clients to a 700 or greater while they're in the program. But sometimes, of course, some clients just get to the score that is needed to get pre-approved, or some keep working on getting to 700, even though they go ahead and get pre-approved because they're ready to at least start that process. I want to show you, let's see, another one. This is Miss Spite. She also came to us wanting to establish credit for her business in the middle of March with a 563, a 565, and a 584. And then 2.5 months later, we got her to a 733, a 736, and a 742. Let's see. Any questions about the before and afters?
Well, I do have a question about this one.
Yes,
Because that's a significant increase.
It is.
So was it the fact that she already had some trade lines that you just kind of needed to mix with, or did she was more like a blank credit report and you were able to just kind of like, okay, here, open up this credit card or this? I mean, I'm just curious. I know everyone's different and every case is different. Yeah, but I'm just trying to see how she jumped like almost 125 points with all three of them almost.
Right. I think hers
not just two, all three of them.
Right, exactly.
Okay.
Hers had a lot to do with her credit cards and the balances. So her utilization was high, so getting her to pay those cards down. In addition, I'm sure we got a few things deleted from her report. So that was what supported her with moving forward so quickly. But also, you can move forward really quickly if you don't have credit cards, because if you're missing 30%, so then that means me adding 2 credit cards are going to jump those scores as well. Typically, there are some people that I do look at their credit report and I can see, it's going to be like pulling teeth, because there's not a whole lot of wiggle room. Let's say their balances are already down. I'm like, oh man, there's no room to grow there. Or there's not a whole lot of derogatory things that we can challenge. And maybe they have all of they may have all of the diversity in terms of credit cards. So I'm looking at, okay, so where do I get to pull some scores out of here? Yeah, so it can vary. And then we get creative, like, okay, well, you got an auntie with a credit card that has we can get added to as an authorization as as an authorized user. So we're constantly looking for other ways. But yeah, for her, I think it had a lot to do with her actual balance.
Okay, thank you.
Okay, you're welcome. All right, anybody else in terms of the before and afters? No? Okay, all right. Let's see. So now, just with respect to business credit, one of the things that we mention business credit is because a lot of business owners are unaware of how business credit works. And so business credit is your ability to buy items, of course, on credit, or to establish credit, but it's not on your personal credit report. It's under your business. However, that's something that needs to be established. So there's a kind of strategy or a method to having your business appear to be credible on paper, because of course, the creditors know you with your credit score, not your credit score, your Social Security number. You are a legal entity. Businesses, not so much, because you can throw up 5 businesses tomorrow. So they are usually being a lot more, they scrutinize a lot more before they establish or they give credit to a business, because they need to know that the business is going to actually repay that, especially when when its credit has not been established. So we work with business owners to, on paper, check off all the boxes that are required to in order for you to show that your business can should be approved to open an account. And then there's also tiers. So it's kind of like if you have a brand new, if you have a kid that's starting out brand new, a teenager that's getting credit for the first time, you have to start with a baby card. You can't just go right to getting the, American Express card that has points. And so we actually take you through the tiers of accounts that are required to get to a place of establishing credit. And we also educate you on what business credit is. And like I have up on the screen, Dun and Bradstreet's Paydex score and IntelliScore Plus from Experian are the two majorly used to establish credit for businesses. And a person needs to be at least a 680 in order to establish credit for their business, because they will need to leverage your personal scores in order to establish the credit for the business. But we want to make sure that whatever you're establishing, that it's not on your personal credit, so it's not hurting your personal scores, and instead it's impacting the business owner. So I'm going to stop the share here. Looks like we have a question. Is that for me? Let's see. Oh, can I repeat the cards that you should have? Okay, so what I mentioned earlier was that what we recommend is that you have a minimum of 2 major credit cards, 1 department store card, and 1 installment account. And an installment account is like a car loan, a student loan, or a mortgage. So you want to make sure you have those at a minimum. However, again, I'm usually like if a client has no credit cards, I know that I need to give them at least 1 major credit card. I'm usually not worrying about a store card unless I have to, unless they need that as a stepping stone to even get approved for a major credit card. But if you have 2 major credit cards, you don't need to backtrack and get your a store card. That's like a lesser card. It's not as critical. And the last thing that we're adding is an installment loan, because that's not as important as credit cards. I hope that answers your questions, Anna. Anybody else have any other questions? Oh, really quickly, let me just say that for all of our realtors and lenders, we have a system that we have create a portal for you on our system so that you can follow your client through the process, so that you can see where they are, what homework I've assigned, what they've been recommended to do, what their new scores are, how they're progressing through the program, what they just had a new late that dropped their scores, all of that. You have your own portal to go in and see all of your clients together in one roster and see where each of them are. And in addition, I meet with my realtors and lenders periodically to go over the where their clients are and what how soon it looks like we what type of progress they're making in the program. Put it that way. All right. Anybody have any other? Oh, let's see. This looks like that was just a thank you, I think. Hey, Ethel. Yes, ma'am.
Yes. So on the soft pulls that the mortgage lenders say they get, explain that. I mean, I need just some assurance that when they say, "Hey, we could just look at your client's numbers real quick and just do a soft pull and it won't affect anything."
Got it. Okay, so a soft pull is just that. So a soft pull is when you look at it, but you're not saying that you're attempting to get this person approved or you're trying to open an account. So now from a mortgage standpoint, I would almost be inclined to say that a mortgage lender would need to explain that from their end, because typically when a client tells me my lender just pulled my scores, I usually see that on their credit report. However, I do know, like, for example, when I'm going to get somebody approved for a card with Capital One has a pre-approval process. I put the information in, they say, oh, based on what we see so far, we may be able to get you approved for this card, or this card. Then when I select the card, it actually does the hard pull. But before that, up until that point, it is a soft pull and it doesn't hurt their credit. So we actually, it doesn't actually it doesn't show up. So that one, if they tell us nope, we can't get you approved, it doesn't show up on their credit. Or if they say we can get you approved for a pre-approved card, and the card, I mean not pre-approved, a secured card, credit card, and the client decides they don't want to move forward just yet, it doesn't show up either. So typically a soft pull is almost like the creditor, the client looking at their own credit.
Oh, okay. Okay.
Yeah, and yeah, so if a mortgage lender is saying that, I would just, hold them to it, because I'm sure that the mortgage lender is probably being, truthful with you in that stance. But sometimes I do tell clients, sometimes they'll go other places and have them tell them, oh, you can get this, it's not gonna hurt your credit. And then they find out it is, because the person's just trying to sell them whatever it is. But I
Okay.
doubt that, yeah, but I doubt, based on the relationships that lenders need to develop, I don't think that they would go out saying that, because it will show right up. You can
Right.
usually see it on
Okay.
the report. Yeah. Also, a lot of people don't know that most credit card companies do a soft pull on your credit every month to see where you are now. So sometimes when you can have your credit limit be lowered because you are getting into trouble with other creditors, and they're like, well, yeah, we don't want to be next. So they can either lower your account, lower your credit limit, or they can actually close your account
Your
out.
line. So
Exactly.
how can a consumer be protected against when they do pull credit?
Mhm.
A lot of my clients, the credit companies are selling their phone number. And so they start getting spams on the same day from other lenders who
Oh,
bought their lead. It's like
oh
leads being
wow.
sold on inquiries, and they get 15 different calls from one lender pulling their credit.
Yeah, that's tough. Now that part I don't, that I can't, because I don't know how that works in terms of, I guess when you are, probably it's somewhere in the paperwork that says that if I pull your credit, we can do these particular things with your information. And I don't know whether there's some way that they can opt out of that. So
All
that
they
part I
said is
don't know.
there is an opt-out form that they can fill out, but it can take 60 days for that opt-out form to work. So
Wow.
now I'm just telling my clients to sign an opt-out form, and then to tell the lender not to put their phone number in the file
Right.
when they're
Yeah.
doing it. But they're saying if their numbers on anything inside the credit report,
Oh
when
wow.
your credit is pulled, they'll sell your phone number, and they follow up with leads to say,
Yeah.
hey, I understand you want a mortgage. Can I get you a mortgage? Just bam, 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 bam. I mean, it's like spam all day long for
Oh
this
yeah.
one guy.
Oh yeah, I can imagine, because we get spammed all the time with those pre-approvals that you get in the mail.
Yes.
I see your question. I'm going to answer that next. So yeah, you get there's a constant commercialization of trying to get you to buy something. And so everybody's always hitting you up, and you're getting hit up by Capital One and Credit One and Premier, everybody even a Credit Karma. A lot of people are like, well, Credit Karma says if I open this account, it's going to help my scores. I'm like, yeah, because they're getting paid to tell you that. Like, they're getting paid if you open this credit card. You can't assume that actually is really going to help your scores. So I would, steer clear of that. That is them fishing, attempting to see if they can sell you something. And unfortunately, we're in a very capitalistic society that everybody's trying to get somebody to buy something. So yeah. So now, question about our fees. So what we typically, I'm going to show my fee structure. It is actually, this is the generic fee structure. It varies for each client depending on what is on their credit report. So we typically ask our realtors and lenders to, first of all, don't set your client up and have them believe that this is the price when it could possibly be something different. So usually let them have a consultation with us first. But the setup fee for one person is $250. That gets them started with the program, and then it's $150 a month or no more than 6 months. And we tell them no more than, because they are not under contract. As soon as they get to scores that work for them and that they are ready to get pre-approved, and the lender is like, yeah, we can give it a go, then they can stop the program, and that would stop their fees. I also say no more than, because if we get to month 7 and we still have work to do to get their Vantage Point score to at least a 700, as long as they did their part, we're going to continue doing the work, but they won't have any additional program payments. That's how we honor the guarantee. So I like to tell clients, if we don't get you to 700 on your dime, we're gonna get you there on ours, and we don't like working for free. And their part is they need to, and I'll answer your question next, Marissa. They need to have no new negative items. That's no new late payments. Don't hit me with anything new that's going to drop your scores and then expect me to get you, guarantee to get you to a 700. I can't do both. So you can't hit me everything that's new that's presenting to your credit report that is actually making it go in the opposite direction. Two, that you get all of your existing credit cards now between 1% and 10%, and you keep them there for the duration of the program. And then three, that you not open anything else without consulting with me, because new accounts can lower your scores. So they do those three things, we guarantee to get them to a 700. They get their Vantage Point score to a 700. We do have a discount for couples, and the rate, they save $100 on the setup fee, and then save $50 per month on the monthly fee. And couples is any two people. That doesn't have to, they don't have to be married. They could be sister and two sisters, or a mother and a daughter, or any two people. In terms of the setup. I mean, in terms of the couple. And like I said, this is the generic cost though. So I can look at their credit report and the price could be lower. And so I won't know until I look at their report and see what their credit needs are. And so until I see the report, we typically, I'll review their credit report and then I go over what their fees are. Anybody have any questions about that? No. Okay. And Marissa, you had a question.
And you may be going to it next. I apologize. Is that the same for business clients? If they don't need help with the personal credit, but they want help with the business credit?
Got it. Okay. Actually, no, I wasn't, but I can go ahead and mention it. So let's see. Business credit is $250 a month for 4 months, and the program is 4 to 6 months. So we're saying within 6 months, you should be at the place where we've gotten you approved for a tier 3 credit card, which is one of the big boys. Yes, ma'am. Let's see. Budgeting, and looks like we have 2 more minutes, so I'm going to try to keep it tight to the 4. To the 1 o'clock. Let's see. Budgeting, most people ask for, yeah, they do have budgeting help. I have a bookkeeper that I work with. So people need help learning how to manage money, track their money, find out where their money is going. I do have a bookkeeper that's really good, and she will sit down and support them in getting their using an app and explaining how to keep track of their money. So we do that too. Also, student loan forgiveness. We do have a company that I work with that does free consultation to see if clients are eligible for student loan forgiveness. And if once they know whether they're eligible, either the company, they could pay the company a fee to pay for, they could pay the company a fee, or they can actually just do the forgiveness paperwork themselves. Now, for student loan forgiveness, I'm usually recommending to my clients, don't get approved before you buy the house, because some of those student loans are really, really, really old, and they are helping the credit. So I don't want those loans to go away because they are aging my file. So I'm very protective about a client's age of file. All right, so I know I've thrown a lot at you guys. You can, if you want to, you can schedule more time with me if you have more questions. Also, you can schedule a consultation with me if you want me to take a peek at your credit report, and if you have any clients that you would like for me to take a look at. That consultation is no charge.
Okay, thank you, Sonia.
So sorry. I went
No,
all the way
you're
up to
fine.
4.
No, it's fine. It's fine. Does anyone have any last questions for her? You know, because this is very, very good information. I learned something even more just sitting here like, oh, okay. I have one last question before we go though. Is it the difference between the secured credit card and a regular credit card in terms of the credit cards you get to increase your score?
They operate the exact same on your credit report, but they operate the exact same too in terms of how you got to use them. So some people think of them as a prepaid card, meaning that's my $200, so I get to spend. No, that your money is somewhere in an account somewhere. This is $200 that they're loaning you. They just depositing your $200 as security. So you still have to, if you spend it if you max this out, it's gonna hurt your scores. So you don't get to use it like a debit card. That's not it's still a credit card, and you're still borrowing $200 or however much the credit card is. Good question.
Oh, okay, thank you. Thank you. Okay, everyone. Well, I appreciate everyone being here on the Power Hour. We have more to come next Power Hour. I believe we have new laws updates, but we will get that flyer out to you. You guys have a great rest of the week, and we appreciate all of you. Would Madam President, would you like to say something in closing?
Yes, I'm excited to say that tomorrow is the release of our first drop of membership listings. So every Wednesday, the due date is every Wednesday. If you have new listings or are coming soon, one drop per property. So don't drop the same property every week for a year is the note. But we will be sharing our listings on email and social media for our members every Friday. So look forward to it. Look forward to that tomorrow. Thank you.
All right, great. Okay, thank you, everybody, for attending. You have a great rest of the day. See you later.
Thank you.
Thank you.